Somewhere around her 43rd birthday, a schoolteacher in Ohio opened her retirement account, did some quick math on a napkin, and realized she was roughly 12 years behind where she needed to be. So she did what a surprising number of Americans do the moment they feel behind. She moved most of her savings into the fastest-moving, riskiest investment she could find. Not because she was reckless. Because she was scared, and scared people don't usually make cautious decisions, they make urgent ones. Here's the part that should stop you for a second. If you told her that a hedge fund manager in 1999, a homeowner refinancing in 2006, and a crypto trader buying the top in 2021 all made functionally the same decision, for the same reason, at the same stage of life, she probably wouldn't believe you. But they did. Different decades, different assets, completely different headlines. Same trap. And it's a trap that seems to spring shut specifically after 40, once people finally have enough money to lose, and just enough fear to lose it badly. So the real question isn't whether you're saving enough. Almost nobody feels like they are. The real question is this: the moment you finally admit you're behind, what does that feeling make you do? We're going to work through 3 questions today. First, why does this exact mistake cluster so heavily around people in their 40s and 50s, instead of showing up randomly across every age group? Second, who actually profits when a huge slice of a generation panics at the same time, because in markets, someone always does. And third, what is it people are missing in the moment they make this decision, because almost none of them think they're taking a wild swing. In their own heads, they think they've finally figured it out. Hold on to one image while we go through this. A batter, down to his last strike, bottom of the 9th, decides the smart move is to swing as hard as he possibly can at the very next pitch, no matter where it's thrown. Not because it's the highest percentage play. Because it's the only play that feels like it could fix everything, all at once, right now. We're going to come back to that swing more than once, because it quietly explains almost everything that follows. Before we go further, it's worth challenging an assumption a lot of people carry without ever examining it: the idea that panic and poor decisions are things that happen to other people. Careless people. Uneducated people. That's not what the data shows. Some of the worst versions of this mistake get made by people who are otherwise sharp: engineers, doctors, small business owners, even financial professionals managing other people's money competently while mismanaging their own. Intelligence doesn't inoculate you against urgency. If anything, smart people are often better at constructing a convincing internal story for why the risky move is actually the rational one. That distinction matters, because this isn't really a story about foolish people doing foolish things. It's a story about ordinary human psychology running headfirst into an unforgiving calendar. So, why 40? Why not 25, when the math would actually be forgiving, or 60, when people are supposedly more cautious? Researchers who study retirement behavior have long described something like an awareness gap, the space between when people vaguely know they should be saving more, and the moment that fact becomes emotionally real. For a lot of Americans, that gap doesn't close in their 20s or early 30s. It closes somewhere in the 40s, when a kid needs braces, a parent needs care, a mortgage is still stubbornly large, and retirement stops being a distant abstraction and starts looking like an actual number with a due date attached to it. Data tracked by major retirement providers like Fidelity and Vanguard, which follow millions of workplace accounts, has repeatedly shown that a large share of people in their 40s and 50s have saved only a fraction of the amount standard retirement benchmarks suggest they should have by that age. The exact shortfall shifts depending on the year and the survey, but the underlying shape almost never changes. Awareness arrives late, and when it arrives all at once, like a light switching on in a room you didn't realize was that messy. That's the setup. Here's the part almost nobody expects going in. The response to that sudden awareness is, more often than not more discipline. It's more risk. Think about what actually closing a savings gap requires, mathematically. If you're behind on a 20 or 30-year plan, the boring, correct fix is to save more, consistently, for longer. That's not a satisfying answer to a 45-year-old who feels like the clock is already running out. So instead, a lot of people quietly reach for a different lever. Instead of increasing the amount going in, they try to increase the speed at which the money grows. And the fastest available way to try to do that is to take on outsized risk, usually at the exact moment they can least afford a mistake, because they no longer have 25 years to recover. They have 12. Or 8. Or 5. This is where the story stops being theoretical, because this exact pattern has played out publicly, more than once, in ways you can actually track with real numbers. Start with the late 1990s. The Nasdaq Composite climbed from around 1,000 points in early 1995 to over 5,000 by March of 2000, a run driven heavily by internet and technology companies, many of which had no profits and, in some cases, barely any revenue at all. A meaningful share of the money pouring into those stocks during the final, most euphoric stretch of that run came not from 25-year-old day traders, but from older investors, people in their 40s and 50s, rebalancing retirement accounts into tech-heavy funds because slower, diversified returns elsewhere had started to look embarrassing by comparison. When the bubble popped, the Nasdaq lost roughly 78% of its value from peak to trough by late 2002. People who had been comfortably on track for retirement in their 50s suddenly found themselves needing to work another decade. The tragedy wasn't that they invested in stocks. It's that they concentrated the riskiest part of their entire portfolio at the exact moment they had the least room left to absorb a mistake. Jump forward to 2006, and the asset changes but the age pattern doesn't. This time it wasn't stocks, it was houses. Homeownership had always carried this near-mythical status in America as a close-to sure thing, which is part of what made it so dangerous. Between 2000 and 2006, national home prices roughly doubled in many markets, and a large number of middle-aged Americans, many still stinging from dot-com losses and feeling behind on retirement, poured money into second properties, home equity lines of credit, and adjustable-rate mortgages, treating real estate as the new fast lane to catching up. When the housing market collapsed starting in 2007, U.S. home prices fell nationally by around 27% over the following years. Millions of people, disproportionately those in their 40s and 50s who had leveraged the hardest, lost not just paper gains, but actual homes. Again, this wasn't a story about real estate being a bad investment in general. It was a story about real estate being used as a shortcut by people racing against a deadline they'd only recently admitted was real. Now here's where it's worth pausing on the crisis that followed, because it deserves its own moment rather than a footnote. The 2008 financial crisis didn't just wipe out home equity, it hammered retirement accounts broadly, at the worst possible time, for the worst possible group. Between late 2007 and early 2009, the S&P 500 lost more than half its value. For a 28-year-old, that's a rough couple of years and then, historically, a strong recovery with decades left to compound. For a 58-year-old 5 years from a planned retirement, it was closer to catastrophic, because there was no long runway left to simply wait it out. Surveys conducted in the years after the crisis found that a significant share of older workers delayed retirement, some by 5 years or more, specifically because of losses sustained in 2008 and 2009. And a portion of those losses weren't just passive market decline, they came from portfolios that had been quietly shifted toward riskier, higher growth allocations in the years just before the crash, by people trying to make up ground after the dot-com years. The same age group, catching the same kind of falling knife, twice in less than a decade. Then, more recently, cryptocurrency. Bitcoin went from under $5,000 in early 2020 to nearly $69,000 by November 2021, a climb that made patient, diversified index investing look almost pointless by comparison. Surveys conducted during that period, including some from firms tracking retail investor behavior, found a notable share of new crypto buyers were not the 20-something tech enthusiasts you might picture, but people in their 40s, often citing feeling behind on retirement as a specific, stated motivation for buying in. When Bitcoin fell to around $16,000 by late 2022, a loss of roughly 75% from its peak, a lot of that catch-up money didn't just underperform. It evaporated, and unlike a stock in a retirement account, a lot of it had gone in outside of any tax-advantaged, diversified structure at all, which meant there was no cushion, no rebalancing, nothing standing between that fear-driven decision and the full force of the crash. 3 completely different decades. 3 completely different assets, one built on software, one built on land, one built on code nobody could fully explain to their own spouse. And yet, in each case, the same age group is disproportionately represented at the top of the buying frenzy. The same emotional trigger sits underneath all 3. The same outcome follows. So here's where we come back to that swing at the last pitch. In every one of those cases, the investor wasn't gambling because they were greedy in some cartoonish, mustache-twirling sense. They were gambling because the safe path no longer looked fast enough to matter anymore. When you're down to your last strike, a single, bases-clearing home run stops being one option among several. It starts to feel like the only option worth taking at all. The trouble is, in real markets, the pitcher doesn't have to throw you anything hittable. The market doesn't owe you a comeback on your personal schedule. It just runs on its own timeline, completely indifferent to the fact that you're now 46 and doing math you wish you'd done at 28. Now, who actually benefits when this happens on a mass scale? This part is worth being honest about, because it's rarely the person swinging for the fences. In each of those historical episodes, there was a group on the other side of the trade that was not emotionally invested in the outcome the way the retail buyer was: professional investors, institutional funds, and in some cases company insiders, quietly selling into the enthusiasm rather than buying into it. During the dot-com run-up, insiders at a number of late-stage technology companies sold significant portions of their own personal holdings in the final year before the crash, cashing out gains, while retail investors, many of them older and catching up late, were still buying in. In the run-up to the 2008 crisis, several large financial institutions were packaging and selling mortgage-backed securities to investors, even as some of their own trading desks were quietly betting against those exact securities, a fact that later became public and the subject of congressional investigations and, in some cases, regulatory settlements. None of this requires a conspiracy theory to explain. It only requires one basic, unglamorous fact about how markets work: somebody has to be on the other side of every trade, and the participants who are calmest and best informed tend to come out ahead of the participants making decisions out of fear. That's an uncomfortable structural truth, and it's worth sitting with rather than rushing past. The urgency that makes catch-up investing feel necessary is precisely the same urgency that makes you a predictable, exploitable counterparty for someone calmer than you happen to be in that moment. There's a second, quieter beneficiary too, and it's one people rarely think to name: the entire industry built around selling certainty to anxious people. Financial media, certain newsletters, and no shortage of self-styled trading gurus have built enormous audiences specifically by targeting people in their 40s and 50s who feel behind. The pitch is almost always some version of the same promise: a system, a strategy, a coin, a fund that will compress 20 years of missed compounding into 2 or 3. That promise sells extremely well precisely because it's aimed at people in genuine emotional pain about their financial future. The product being sold isn't really a strategy. It's relief. And relief, unfortunately, is not the same thing as a return. Let's dig further into the psychology now, because this is really where the mistake gets made, not in a spreadsheet, but in a feeling, usually late at night, usually alone with a phone or a laptop. There's a well-documented behavioral pattern called loss aversion, first studied extensively by psychologists Daniel Kahneman and Amos Tversky, showing that people feel the pain of a loss roughly twice as intensely as they feel the pleasure of an equivalent gain. By the time someone hits their 40s and looks honestly at their retirement account, what they're often experiencing isn't really about the future at all. It's a present-tense sense of loss: lost time, lost years they can't get back, decades that already happened and can't be renegotiated. And loss aversion doesn't make people cautious in that moment. Counterintuitively, it often makes people more willing to gamble, because taking a big swing feels like the only available way to avoid locking in what already feels like a realized loss. It's the same psychology that explains why a gambler, down for the night at a casino, often bets bigger on the last hand instead of walking away. They're not really trying to win more money at that point. They're trying to avoid the specific feeling of the whole night having been a loss. Layer on top of that something researchers call the recency effect. Whatever asset has performed best recently is the one that feels safest, even though strong recent performance is frequently the clearest warning sign that an asset has become overpriced, rather than a reliable signal that it will keep performing that way going forward. Tech stocks felt safe in 1999 because they had already gone up so much. Houses felt safe in 2006 because prices had done nothing but climb for years. Crypto felt safe to a lot of new buyers in 2021 because it had already visibly made some early adopters rich, and very little builds false confidence quite like watching someone else win in real time. There's a related bias worth naming here too: confirmation bias. Once someone in their 40s decides, even half-consciously, that a certain asset is going to be their catch-up plan, they don't go looking for reasons it might fail. They go looking for reasons it will work, and the internet is extremely good at supplying exactly that kind of validation on demand. Entire communities exist online built almost entirely around reinforcing a shared belief that a particular stock or coin is undervalued, misunderstood, and about to take off. Doubt gets filtered out before it ever has the chance to change anyone's mind, which means the very moment someone most needs a skeptical outside voice is often the moment they've most successfully insulated themselves from hearing one. And then there's a quieter driver that gets far less attention than either of those: social comparison. Somewhere in their 40s, most people start hearing, at dinners, in group chats, scrolling social media late at night, about someone they know who got in early on something and made real money. It's almost never the full picture. Nobody posts publicly about the trade that went to zero, or the leveraged bet that wiped out a chunk of a retirement account. But that one visible success story does an enormous amount of psychological work, because it quietly converts a private financial fear into a public, comparative one. The question stops being, am I saving enough? It becomes, why did they get rich and I didn't, which is a completely different and far more dangerous question to be asking yourself at midnight with a brokerage app open. There's one more player in this story worth naming, because it doesn't get nearly the attention the crashes do: the financial products built specifically to sell certainty to people who've just discovered they're behind. Walk into enough seminars aimed at people in their 50s and you'll notice a familiar pitch: complex annuities and structured products promising guaranteed income, protection from downside, and market-like growth all at once. Some of these products serve a legitimate purpose for the right buyer in the right situation. But a meaningful share of them are sold specifically at the moment of maximum fear, in hotel conference rooms after a free steak dinner, to people whose main qualification for buying is that they're anxious, not that the product actually fits their situation. Regulators, including state insurance commissioners and the SEC, have repeatedly flagged aggressive annuity sales tactics aimed at older savers as a recurring area of complaint. The fees embedded in some of these products can run considerably higher than a simple index fund, and the surrender charges for pulling money back out early can be steep enough to trap a saver in a product that never quite matches what was promised on the glossy brochure. It's the same underlying story wearing a suit instead of a hoodie: someone calm and well-informed on one side of the table, someone anxious and behind on the other, and a product engineered to convert that anxiety into a sale rather than genuinely solve the underlying problem. It's worth stepping back here to look at one more historical example that widens the lens beyond the United States, because this pattern isn't uniquely American. It's a human one that shows up wherever aging populations meet financial anxiety. Japan's asset price bubble in the late 1980s saw real estate and stock valuations reach levels that, in hindsight, were almost impossible to justify. At one famous point, the land under the Imperial Palace in Tokyo was estimated to be worth more than the entire state of California. When that bubble burst in the early 1990s, Japan entered what's now widely referred to as the lost decades, a prolonged period of stagnant growth and depressed asset prices that stretched on for years. Middle-aged Japanese workers who had leaned hardest into real estate and stock speculation during the boom, often specifically to build wealth quickly after feeling behind earlier in their careers, were among those hit hardest and slowest to recover. The specifics differ from the American examples, but the underlying mechanism is identical: a generation feeling behind, reaching for speed instead of consistency, right as the ground shifted beneath them. So here's where we can finally answer the questions we opened with. Why does this mistake cluster so heavily after 40? Because that's typically the first moment fear becomes concrete instead of theoretical, and concrete fear consistently pushes people toward speed instead of consistency. Who benefits? Calmer, better-informed participants sitting on the other side of those same trades, institutions, insiders, and disciplined long-term investors who aren't making decisions under emotional pressure, along with an entire ecosystem built around selling relief to anxious savers. And what are people missing in the moment? They're missing the fact that the swing-for-the-fences move isn't actually the high-probability way to catch up. It's the low-probability way that happens to feel the most emotionally satisfying in the moment, which is a very different thing from being the smart play. So what does actually work, if urgency doesn't? It's a lot less cinematic, which is exactly why it never spreads the way a crypto success story spreads. The mathematically reliable way to close a savings gap in your 40s or 50s is time in the market combined with a meaningfully higher, sustained savings rate, not a higher-risk bet. $1 invested consistently at 45, left alone through market cycles rather than yanked in and out chasing whatever happens to be hot that year, tends to outperform a single concentrated bet made under pressure, because concentrated bets carry a real, ever-present chance of permanent loss, and permanent loss is the one outcome a shortened timeline genuinely cannot recover from. This isn't a guess. It's the same lesson that shows up, again and again, in every one of the historical episodes we just walked through. The people who came out fine after the dot-com crash, after the 2008 collapse, after the 2022 crypto downturn, were disproportionately the ones who hadn't gone all in on the thing that was working right before it stopped working. There's a less obvious fix too, and it has to do with reframing what behind actually means in the first place. Being behind a projected retirement number at 45 doesn't mean the plan has failed. It means the plan needs adjusting, working a few years longer than originally hoped, gradually increasing contributions, or accepting a somewhat different lifestyle later. None of that is dramatic. None of it makes for a good story at a dinner party. But all of it is dramatically more reliable than trying to erase 20 years of underfunding with one bold, concentrated trade made in a moment of fear. Increasing a 401k contribution by even 3 or 4% in your mid-40s, and simply leaving it alone for 15 or 20 years, does far more real, compounding work than most people give it credit for. It's just boring, and boring things rarely go viral. It also helps to have a concrete way to tell the difference, in the moment, between a genuine opportunity and a catch-up trap dressed up as one. A few honest questions tend to cut through the noise better than any amount of research into the asset itself. Would you be this interested in this investment if it hadn't already gone up a lot recently? If the answer is no, that's the recency effect talking, not analysis. Are you sizing this position based on what you can afford to lose, or based on how much you feel like you need to make up? Those are two completely different numbers, and confusing them is exactly how a reasonable position turns into a portfolio-wrecking one. And finally, if you had to explain this decision to a calm, financially literate friend who had no idea how behind you felt, would it still sound like a good idea? Stripped of the urgency, most catch-up bets don't survive that question, and that's usually the clearest sign of all. None of this means ambition is the enemy, or that every investment made after 40 is secretly a mistake waiting to happen. Plenty of people build real wealth in their 40s and 50s by starting businesses, buying appreciating assets, or taking calculated, well-sized risks with money they can genuinely afford to lose. The difference isn't the presence of risk. It's whether the risk is being taken from a position of strength, with money that has room to be lost, or from a position of fear, with money that's supposed to be the retirement plan itself. That distinction is easy to state and surprisingly hard to feel, in the moment, from the inside of your own panic, which is exactly why it's worth having thought through in advance, before the moment actually arrives. Let's go back to that swing one final time, because it's really the whole story compressed into a single image. A batter down to his last strike who chases a wild pitch outside the zone isn't being brave. He's letting the scoreboard dictate a decision that should really be based on the pitch itself. The scoreboard, in this case a retirement number that suddenly feels too small, is real. Nobody's pretending it isn't. But it doesn't change what a genuinely good decision looks like in that moment. The batter who lays off the bad pitch and waits for a better one, even with the pressure of the ninth inning bearing down on him, is playing the version of the game that actually wins more often over a full season. It's just far less thrilling to watch in the moment it's happening. That schoolteacher from the very beginning, the one who looked at her account at 43 and panicked, her story didn't end with the concentrated bet. After watching a chunk of her savings swing wildly for about 18 months in something she barely understood, she pulled back, sat down with a fee-only advisor instead of taking a hot tip from a coworker, and rebuilt her plan around something boring, a diversified portfolio and a higher monthly contribution she could actually sustain. It didn't make for a great story at dinner parties. It didn't feel dramatic or redemptive in the moment. But it was the version of catching up that actually had decent odds of working, instead of the version that just felt like it did while it was happening. That's really the lesson sitting underneath everything we've walked through today. The financial mistake that keeps repeating across generations isn't ignorance, and it isn't laziness. It's the very human instinct to answer fear with speed instead of consistency, and it tends to show up exactly at the moment in life when speed is the single most expensive thing a person can buy. If there's one thing worth carrying out of this video, it's this: the moment you feel most behind is precisely the moment your decisions deserve to slow down, not speed up. That one shift in instinct, more than any specific stock, fund, coin, or hot tip, is usually the actual difference between the people who quietly catch up over the following decade and the ones who spend that same decade explaining, to themselves and everyone else, what happened to the money? If videos like this help you see these patterns a little more clearly before they show up in your own decisions, that's really the whole point of what we're doing here.